Hello, and welcome to the Logistics Management Podcast. My name is Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome Chris Rogers back to our podcast. Chris serves as Head of Supply Chain Research for S&P Global Market Intelligence. Chris has more than 10 years of experience in building research businesses covering corporate decision making and government policy within the supply chain and logistics sectors for S&P Global. And he's also had experience at Bloomberg and Flexport. Chris's prior experience includes power, gas, and emissions markets analysis at investment banks, including JP Morgan as well as UBS. Chris, welcome back to the podcast.
Thanks for having me, Jeff. It's great to be back.
Yeah, absolutely. Always a pleasure to catch up with you. So, Chris, why don't we sort of start where we often do when we talk on a monthly basis, and that simply would be when we're looking at sort of the state of United States bound imports.
Mhm.
Um, to take it from a little broader angle, just for those that may not be familiar with your work, how could you please characterize, Chris, how 2025 ended up? And sort of how 2026 is beginning when we look at US bound imports and shipments?
Yeah, of course. Thanks, Jeff. So what we do in the research is we gather together our data, bill of lading based data under our Panjiva product, and we use that to look at the US inbound trade flows. Obviously, 2025 was a year of extreme volatility. We had a big run up in container volumes at the beginning of the year. The first quarter was up by around 7% year over year.
Yep.
And then interestingly, in the second and third quarter, although we had all of the tariff events and drama going on, actually the year over year growth was minimal. So what we've seen in the fourth quarter and then coming into January is the hangover from last year's inventory building. So effectively in the fourth quarter of last year, US seaborne imports were down by around 5.5%. And then funnily enough, we've just released data for January that shows there's another 5.5% decline. So yeah, we're kind of sliding down the other side is how I would characterize it.
Okay. Okay. I mean, um, there's a lot of factors that go into that, and one that we've been talking about for literally years, Chris, is simply tariffs. So why don't we sort of look at the tariff outlook? There's some expecting the United States Supreme Court to potentially rule on the White House's IEEPA tariffs, the International Economic Emergency Act, Protection Act, that is. Um, and so, without getting too far ahead of my skis, Chris, why don't we start with the tariff outlook in general, and then we can shift gears over to the Supreme Court in terms of what we may be in store for on that front.
Yeah, sure. So perhaps for your listeners who don't spend time down in the weeds, the IEPA, the International Economic Emergency Powers Act, was originally designed for the president to be able to act on the economy during the Cold War. And the Trump administration last year implemented tariffs on specific countries by declaring that the US trade deficit constitutes an economic emergency. That's led to the application of a whole range of different tariffs, ranging from 10% to the UK up to 50% for Brazil. But it's important to note that that's not the only tariff game that's in town. We also have
Right.
Section 232 duties. This is all to do with national security, which for steel and autos makes a lot of sense because you want a strong manufacturing base if you're going to have a strong defense base. So the national security join is there. But it's been used more widely as well in application to the pharmaceutical sector, electronics, critical minerals, and so on. And in many regards, the Section 232 duties are the ones that a lot of cargo owners care more about because they're the ones that are more likely to be sticky from a legal perspective. They've been challenged in law before, they're a fixed part of the legal base. And so they are not being reviewed from a legal perspective, although many of those cases, the tariffs have yet to be actually applied. So they're more uncertain in application than they are from a legal perspective.
Okay. All right. Um, and so when we look at the Supreme Court and what may happen, obviously there's a lot of other avenues as you very much outlined here, Chris. Um, let's say that the Supreme Court rules against the White House. What does that mean at that point subsequently for supply chain stakeholders, BCOs or beneficial cargo owners, that is, maybe from a strategy or a planning perspective, for example. And also if if they rule four, what would that mean as well?
Yeah, sure. So, if you're a planning strategist, in many regards, you'd rather they just ruled for it, so you can just move on and you haven't got to try and second guess what happens next.
Yeah, yeah,
Obviously, most companies would prefer the tariffs aren't there. So, if we go down the track, the IEPA, the use of IEPA for tariffs is overruled. Then there's the decision tree then drops down two branches. One branch is effectively what does the administration do next? We're convinced that they will use one of their other tariff measures, whether it's that national security approach I already mentioned,
yep,
Section 301, Section 122. There's a whole menagerie of different approaches they could follow. So, from a functional economic perspective, tariffs are here to stay, whether they're at a 15% rate on everybody or something more nuanced. The other part of the planning that has to go on is, will the Supreme Court backdate that decision? So, will they say, yes, these tariffs are illegal, they should never have been put in place, and therefore refunds need to be provided as well? Um, in large part, that's a cash flow issue for the short term. I don't want to kind of like underplay how important that is. We're talking about tens of billions of dollars.
yeah,
We are already seeing some sophisticated financial products being put together, effectively traded customs bonds. So the right to refunds are already being traded. So, there's clearly some very smart people in the financial community who believe that the tariffs will be both overruled and that they'll be overruled retrospectively as well. But from a planning perspective, for all of our customers in the procurement and specifically in the beneficial cargo owner space, we're saying, look, you've got to count on tariffs being around for the long term, and you need to bake that into your planning, whether that's around your cost cutting plans, your investment plans, or just your network design. Where are you getting stuff from?
yeah. Um, that's definitely that definitely leaves the BCOs and the related parties with more than enough to chew on and contemplate, to be sure.
Yeah, absolutely.
Yeah, no doubt. Um, well, let's move over towards the capacity outlook, Chris, as well as price rates and pricing too. Obviously, really going back to the onset of the pandemic, for that matter, there's been a lot of interesting narratives related to pricing based on uh, related events. How COVID had its impact, tariffs have had their impact. What's sort of the story now?
Yeah, so I think the when we think specifically about the physical aspects of supply chains, and particularly for container freight, we are moving into a new phase where there's a lot of new vessels being delivered. Our estimates show that capacity growth in 2026 globally is going to be just under 5%. That's in terms of new steel on the water. At the same time, our forecast for global demand growth is just under 2%. So there's a 3 percentage point gap there. Now, that doesn't sound a lot in a world where container shipping rates seem to swing by 20% quarter to quarter, up and down. But what it does show is that the fundamental story is that we're going to get more capacity coming on than there is demand growth. And in fact, when you look at the data, and we manage the IMO database, so we get a lot of visibility on new build, you're going to continue to see kind of more 5% capacity growth years for the next
Yeah,
3 years as well. So that gap is only going to open up. The question then is like, what are the behavioral characteristics? Clearly the container lines have shown they understand how to run an efficient blank sailing program to manage capacity on specific lanes, moving that capacity around. Um, but the biggest question for them is, do they want at some point to start scrapping older vessels? Now, the irony there is that the older vessels, which are effectively the smaller vessels that have been around for 20 years already, those smaller, older vessels are actually quite useful on feeder routes. So they give you that resilience in your network.
Mhm.
So there's a good chance that a lot of the steel will remain on the water. One of the main unanswered questions at this point is what happens with shipping through the Red Sea? Now, depending on whose numbers you look at, you're looking at around 5% to 7% of global capacity is effectively taken out of the system because all of that east to west traffic is going around, well, 80% of it is going around the Cape of Good Hope and not through the Red
Right.
Sea. So if everyone returned to the Red Sea, then we get effectively a whole another year's worth of capacity coming in. Our view is still very much that you will not see a mass return. We believe the Houthis in Yemen still have more to do in terms of disrupting shipping in the area. But we are seeing the container lines dip their toes in the water and start to put more vessels through them.
Yeah.
Note most recently that Gemini have started doing that. So, if anything, capacity is going up, demand is not going up as fast. And, anyone that's done a high school economics class knows what that means.
No doubt. And you had just mentioned Gemini, which is actually an ocean shipping alliance. Um, I believe I believe it's between Maersk and Hapag-Lloyd, but I'll let
Yep.
you confirm that for me. Okay, yes, it is. Good. I was correct. Um, what's sort of the mindset of alliances, not just in terms of the Red Sea, but as they look at the outlook, you had talked a lot about capacity and related impacts on pricing. Do the alliances have a unique approach to that, or is it more that they're just working collaboratively in terms of what the market is giving them and ways in which they can both serve shippers and, turn a profit? Is there more to it than that, or am I overthinking it?
No, actually, no. I think the alliances were a response and remain a response to customer demands, which are driven partly by we want it cheap. Of course, everyone doesn't want to pay a lot for what they want,
Right.
and that involves the efficient use of capacity, um, which in turn also means if you've got a bigger pool of boats to call on, then you can offer your customers the most efficient service, and efficiency generally leads to lower cost. Of course, some customers also have timeliness requirements, whether that is I want it quick or I want it certain. And a lot what was behind when Maersk and Hapag-Lloyd started setting up Gemini and what they've been talking about since is the importance of reliability. So I don't care if it takes 10 days or 12 days. I just need to know whether it's 10 days or 12 days. Not
Hmm.
it could be somewhere around about 2 weeks-ish, possibly. Um, and I think in a world where we've seen a lot more port congestion picking up, which is for all kinds of reasons, whether that's labor strikes or ports trying to deal with the much bigger vessels that are being used on the main lines now. Having that ability to deliver a more reliable service has become a lot more important to many customers. We'd expect that to be an area of ongoing focus. And to get a little advertorial in, the TPM 26 Maritime
Sure.
Conference in Long Beach that our colleagues at Journal of Commerce are organizing, I think that's going to be one of the main areas of discussion. So, discussion about reliability, discussion about how to get costs down, particularly in a world where tariffs will remain and that big blob of costs still has to be paid for.
No doubt about it. Um, Shifting back a little to the import side of things, Chris, in the past, we've always, and you include this, so you do a great job of this in your research notes, talking about the sort of growth drivers or demand catalysts, if you will, whether that's actual consumer demand in the form of consumer confidence too, manufacturing output, um, manufacturing, especially when you look at the ISM data, has been sluggish for a while, although January did take a turn towards positivity with the PMI reading, I believe, topping 50 for the first time in a full year. So maybe that's a sign of better things ahead. But when we look at volumes, obviously more is needed to drive import growth. How do you guys sort of assess or view the need or the lack of a true demand catalyst at this point of the game? And I just ask that because last year we saw a lot of front loading activity, which drove up import levels to really high levels, especially through maybe the third quarter or so of 25. But where does that all stand now? I'm sorry, that's very convoluted wording.
That's okay. Hey, it's a convoluted area. I think if we break it into two parts on the US inbound, from a consumer perspective, consumer sentiment has improved a little bit recently, but it's still, and this is the University of Michigan measure, is still
Yeah.
20% below where it was a year ago. So, there's this whole thing about the vibe economy. People are spending even though they feel bad about the world. But you can't get past the fact that the consumer's not going gangbusters at the moment. We have seen some areas where consumer goods have picked up a little bit, but certainly in that January data we talked about earlier, imports of consumer goods are still well down over time. So we would
Yeah.
need to see a return of the consumer to start with. Now, mathematically, 2026 will look bad because last year it was so high, as you mentioned, because of the reshoring. Excuse me, the inventory build.
Yep.
On the manufacturing side, as you mentioned, manufacturers have turned a little bit more positive. But what's interesting there is when we look at the S&P Global Purchasing Manager Index, PMI, what we see in there is that recovery is being driven by domestic orders. So effectively, it's American firms making more orders, and it's really being focused on specific sectors. We have seen a lot of firms that are buying manufacturing equipment normally have kind of put some of that spending on hold whilst they invest in AI and software tools. The big question is whether we'll see a slew of investment for reshoring. So the response to tariffs is you don't import it, you make it in the United States. Now, if anything, that reshoring approach will act as a drag on demand for inbound services, shipping services over time. Because if you're making more in America with American materials, that reduces the need for those imports. Without getting too kind of futurist and long term about it, we do see the potential, certainly over the next 5 years, that you'll start to see if the Trump administration is successful in reshoring manufacturing, that more trade will be focused on raw materials, plastic, wood, metals, than it will be on assembled goods. So not only will we see lower volumes, we'll also see a change in the shape of what's being imported in favor of those raw materials rather than finished goods.
Okay. Well put. Well put. And just two more quick ones, Chris. You can't help but notice, obviously, um, at a top level, there's definitely tension, obviously, between the United States and Canada, for example. Um, we have the USMCA up for renegotiation in July 26. So maybe China and Canada may be working together on a trade deal, and the EU is working with other non-US
Mhm.
entities as well. There's kind of like this. I don't know what if I want to call it how I would probably call it US decoupling or more of like the U.S. kind of becoming isolated in a sense. And I'm wondering, what that may mean as we look forward. Obviously, it's all very early on here, and who knows what things will look like down the road. But how would you sort of view what's going on with sort of non-U.S. Entities sort of working together, collaborating more on the trade agreement front?
Yeah, I mean, we call it global regionalization. So it's not kind of old school globalization with the WTO at the fore and huge trade deals. It's much more bilateral, and it is leading to some more regionalization, particularly in North America. For North America, as you say, we have the USMCA renegotiation this year. We don't expect that there'll be radical changes in there, but we do see a risk that the negotiations to complete USMCA could drag into very late this year and
Yeah.
possibly into 2027. In the rest of the world, there's lots of deals being done. We've just seen the EU sign a new deal with India. India, of course, have also done their deal, albeit more of a framework with the United States. The EU got to a signing on the Mercosur deal, although that's gone off to the lawyers. As you mentioned,
Yep.
Canada's working with China. So, there's this very much this trend where while the US government is following this path, which is pushing a lot of trade partners away, at the same time, they're kind of pushing them together. So, ironically, we're actually seeing a lot more trade deals getting done now globally, and leading to global liberalization of trade, which is something we're optimistic about over the longer term, than maybe we would otherwise have seen. So, it's silver linings in that regard.
Yeah, absolutely. And just to wrap up, Chris, and I saw it in the data that you and I discuss on a monthly basis. You had indicated that uh, as a whole, um, you guys are currently forecasting that U.S. seaborne imports of container freight will likely decline this year by 8.2% as a whole, versus 2025. Although that comes with some different variations within quarter to quarter movements. For example, you're calling for a 14.5% decline in the first quarter prior to an expected 9.6 improvement by the time the fourth quarter comes around. So I'm just wondering if maybe for our listeners, if you could provide some context behind those forecasts.
Yeah, of course. So the overall theme there was that pickup in trade for the year last year, which was partly the whole front loading thing. And the front loading thing explains why you get that bigger drop at the beginning of the year and then a rebound at the end of the year, because the end of the year of 26 will be comparing to the inventory destocking process from the fourth quarter of last year. So a bit of it's not strictly speaking a supply chain bullwhip, but it's kind of a similar mathematical concept. But for the year overall, not only do you have that drag, that technical drag, you also do have the economic fallout from tariffs, which unfortunately have led many firms to need to increase prices to protect their profitability. As a consequence of which, that has led to higher prices for consumers. That's dragging on demand. Additionally, because we still have this tariff uncertainty out there, a lot of firms have kind of held back on investing on new plant and equipment, and are minimizing, actually even bringing down their inventories further so they can remain more agile in response to the changing trade policy environment. So, 2027 should actually be a reasonably good year as everything normalizes. Although, Jeff, as you say, we've been talking for, I think it's pretty much coming up to 10 years now, and I don't think we've actually had a normal year yet. So it's probably a bit early to
No.
put 2027 as being normal.
Yeah, no, yeah, we'll have to see how that progresses for sure. All right, Chris, this has been great. This brings us to the end of our allotted time for today's podcast. So, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd like to say thanks for joining us again. I believe this is at least your third or fourth time on the podcast. So, thanks for continuing to come back.
My pleasure, and looking forward to seeing you all again.
Yeah, absolutely. And for those of you on LinkedIn, please go ahead and connect with Chris, or check out he's often has some really good posts. LinkedIn.com/IN/CH Rogers ROGERS /. And also please go ahead and give us a follow on Twitter, logistics management, that is, simply at logistics MGMT. And for those of you that are not currently subscribed to our podcast, please go ahead and do so wherever you subscribe. Just look for the Logistics Management Podcast and it will pop right up for you. Thanks, everybody, and have a great day.